In this video, we are going to be analysing Mullen, ticker MULN. Now, it is around 4% now down on the day. Now, what are going to be these key support and resistance levels going further? So now, if we go on to the longer term time frame, which is what we will always start on off, because this provides us our stronger levels, we have one support level to be paying attention to, and that is at 17 cents. This is our statistical mean on the 6-month chart. However, we do now have one problem. If we come down to this level and break it, we have no supports going lower, because we have the 52-week low at 21 cents, and then going any lower, you can see they go negative. Our first deviation on the 6-month is negative 50 cents, and our statistical mean on the 1-year chart is at minus $1.20. Obviously, we cannot trade into the minus, so the only key and kind of strong statistical level we have from the longer term time frame is going to be 17/18 cents. So what we'll do at the end of the video, we will cut down into a short-term time frame to give you some more support levels closer to where we are now. But we do have resistance levels going higher, so what are we paying attention to? And we can see our closest resistance is at 87 cents. If we go higher, we're looking at $1.45/$1.58, and going further will be $2.25, $2.96, and final levels taking us to $4. $6.69 and $9.33. So these are going to be our key resistances. Again, these are longer term time frames, so these are going to provide us at the strongest levels that we can get, but also the time to get to them is probably going to be quite long, especially to the upside. Chances of us hitting 86 cents anytime soon, probably not all that much. But if we do come into here, again, be looking at this as a key resistance. You can play them in two ways depending on how you trade. You can trade short in the initial tap of that level, or if you're a long bias trader, you wait for the break of that level, come back to test it as a support, and if it can hold, it's a good indication that we will then continue to our next deviation level, which in this case would be $1.44. Now though, like we said, we want to provide you support levels. This does seem weak. I mean, if you go over the past year, all this stock has done is gone from 16 cents to $16 to 20 cents. Strong downtrend. Are we going to continue lower? Again, on something like this, definitely possible. So what are going to be key supports going lower? So we're going to use a 20 and 30-day chart, because these are going to give us accurate levels and somewhat strong levels if we're looking to trade within the next few days. So if we can sell off, we're looking at 20 cents and 18 cents as these key zones of support pushing lower. Now what we can see, use this as a zone, because going lower, our next support is at 7 and 10 cents, so very far from where we are now. So you can just use this more of a zone, and this is going to be quite strong. It's a 52-week low, second deviation on both the 6-month the 20-day and the 30-day chart. But also that lined up with our longer term time frame. Where was our statistical mean? It was at 17/18 cents. So seeing that, we basically have 3 deviation levels of support there, and we're going to be at a 52-week low. That may provide some good long bias opportunities. Again, always have your own setup. Don't just be buying blind. But that could be a good setup, and at least looking on the shorter term time frame, we can see it is starting to push down, as it looks more like on a divergence. So this could be a good indication that the downward momentum is getting weaker, which is going to be a great thing if it can continue to push down to the levels we're paying attention to and continuing its divergence. One thing we'll quickly check is how did it look going on to the longer term time frame. So we can see, yes, we're pushing lower, and again, if we can break this 52-week low, it's going to be trading at a divergence as well on the 1-year chart, which again is a good indication, just as another reason for entry. And again, do we go on the 4 hours? Is it trading at a divergence? As it's continuing down now, it seems like it's continuing in a bit of divergence. But again, wait till we actually come down to that level. If we're at hitting 20 cents at a divergence on these longer term time frames, that's perfect. That's going to be really good. But again, also do be looking at the time frame you're looking to actually get these levels, so the 20 and 30 day. If you're trading at divergence on these, again, it's just going to increase that probability of the trade working out. Now, what are going to be key resistances though if we continue higher? So again, we do have levels at around 30 cents. This is our first deviation on both the 20 and 30-day chart. Do be paying attention to these because, again, these will be kind of a key level. But the way to use this is we can see this is kind of where we've been consolidating the last few days, or the last few hours at least. So really the key focus will be where can we actually stay on the side. Right now it would be something I would be looking to ignore, and I would instead wait for a break of either 24 cents or 34 cents before looking to get involved in this. Wait for it to pick a direction, and then they'll kind of give you a clearer sense of direction. Now if we break that and continue up, we have our next zones of resistance at 39/40 cents. Again, if you were getting long at this 20 cents, this would kind of be one of our key targets, or kind of our final target to start looking to get out. Because again, we look to trade to the mean. The reason we trade to the mean is this is where it is considered fair value. Holding past that level is going to be quite risky, and the reason we're going to be using this shorter term time frame mean to give us our levels is because that's where we're taking the levels from. Usually you trade off all, or you tend to use one chart, because then it's a lot easier to kind of judge where your stops are, where are your targets. If you start mixing time frames, you're going to really have not much kind of reward to go from, because if you go on to say a 6-month chart, that might be a resistance. If you go on to a 3-year chart, that might be a resistance. So that's why I tend to just kind of pick one time frame and stick to it when looking to trade. Again, I usually and optimally prefer to use a 6-month and a 1-year chart, but in a stock like this, if you are looking to trade it, sometimes it's not feasible. Anyway though, if we break that and continue up, we start getting some more resistances at 49 and 52 cents. Now again, this is on the 20 and 30-day chart, so we're not going to really go any further than this to the upside, because by the time we hit one of these two levels, if we're hitting 18 cents or we're hitting 52, these levels will probably start to shift, because again, it's only 20 and 30 days worth of data. So if we start pushing out to these kind of levels, these deviations are going to move. The only time you don't need to really, or where we can go further out, is when we're looking at those 6-month and we're looking at those 1-year charts, because, you know, more recent data, if it just does a big shift or, you know, moves down 10%, is actually not going to make a massive difference to the deviations. However, in a case like this, a move of, you know, 5%, 10% in a day, it's going to have definitely some effect on these deviations by the next open. So that's why we don't tend to go too far out on these levels when using these shorter term time frames. And if you want to get onto some more levels, either we'll make a new video when it makes a move, or you can just be looking at those longer term levels to give you those stronger levels. And again, just to know what are those longer term levels, or the ones that we're closest to and should be paying attention to. So again, these are the levels we got from the shorter term time frame, and this is why on stocks like this, where they're so far from those deviations, we go onto those shorter term time frames, because these levels aren't all that visible if you're looking on that longer term level. Now though, again, what would be our key focus? Again, on the support side, $17 17 cents going to be that key area of support, because that is our statistical mean on the longer term time frame as well as a shorter term time frame. To that level, and that's what I would be more focused on Mullen. Again, it's more weak overall. Yes, you're trying to catch a falling knife coming into this level, but you could be literally looking at a cent or two of risk. You know, have a stop maybe at 14 cents. But your upside, you could look for at least kind of 30 cents as a target. So you could get some really good risk to reward if you're looking to trade it. Now again, targets on at least the 1-year chart aren't all that close. We have $1.42 would be the only target, and then also on the 6-month, 87 cents. I mean, these would be the key levels that we are paying attention to. Again, because it's so far off, you're probably best off using the shorter term time frame. But the key focus, and really the only time I would even be looking to trade it, is if it can come into the zone of 20 to 17 cents, because again, there's just so much support coming into this level, at least using standard deviations, that it should be a good bounce location. Anyway, I hope you enjoyed the video. If you did, why not drop a like and subscribe, and check out one of these 2 analysis videos.